Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, amazing people all around the world of crypto and blockchain globally. And today I have another amazing guest. This man is the GM at Shareland. His name is Justin Hughes. Justin, welcome to the show.
Thank you very much. Glad to be here.
I'm glad to hear, and I look forward to speaking with you today. And the topic that we're going to go over, I think I've had a handful of conversations with, and you've always been fascinating to me. But I want to kick things off and ask you first, about your background. Uh,
Yeah, yeah.
what is your background, and is it a logical background for what you're doing now?
Yeah, yeah, a great question, and I would hope so. So my background, I guess if we go all the way back, went to Berkeley, got my degree in cognitive science. Always been a technology guy, and got into software development, was a full stack engineer, and then my first venture-backed startup was RealtyMobile.com. I was the co-founder and CTO there, and our goal there was to basically solve the issue of access when it comes to real estate investing. And at Realty Mobile, we were one of the pioneers in that first wave of real estate crowdfunding back in the early 2010s. And that was the whole point. The point was to get access to people into institutional quality deals. Think, bunch of fat cats around a boardroom, the kinds of deals that the average person is never going to get access to. And we were successful with that. We built a whole platform. We participated in numerous deals, numbering in the billions. I'm now working at a venture studio here in Los Angeles called Share Ventures, and one of our big projects is the Shareland project, and where I'm the general manager. And to me, Shareland is kind of the next logical evolution, especially with the background of blockchain and Web3, what that technology means and what it enables and what it unlocks. And for traditional real estate, no matter how you slice it, when you're fractionalizing equity, there's a lot of operational overhead. You're also at the whims of what's out on the market. Sometimes you could have a bunch of capital to deploy, and there's just nothing that really is all that compelling. And if you do find something, you're in it. You're in it for the long haul. We used to tell our investors 5 to 7 years. Expect your capital to be locked up in that amount of time. And then also, what can be really strange is that there can be real estate investments that just really aren't correlated to the real estate market. There's a lot of factors that go into a deal. It could be the financing. It could be the sponsor of the deal that's doing the deal and the terms of the operating agreement for the vehicle that's going to hold title. And all of these things can dramatically influence what your ROI is and can make it dramatically uncorrelated with what the motion of the market is. And so we saw these limitations, kind of the barriers to scale, the complexities, the lack of correlation, and wanted to solve that. And at Shareland, we've come up with an innovation called the square foot token. And I'll get more into that. But the main point is that it doesn't require the transaction of assets. It doesn't require your capital to be locked up. I mean, you can basically invest as little as a penny for as little as a second and get perfectly correlated one-to-one to whatever submarket you're interested in. Whether you are bullish on Los Angeles or bearish on Miami, you can speculate on the housing markets with what we built. And all of it is made possible because of Web3 blockchain rails. This is not a product that I would personally endeavor to create or operate outside of the core blockchain technologies. We are utilizing the DeFi methodologies that you're probably familiar with, and your listeners as well.
Awesome. So your vision, your mission, your purpose in this and creating Shareland, what is it, and why should people get excited about it?
Yeah, sure. Well, at the core, Shareland is about smarter real estate for all. Our mission is to make real estate simple intelligent, and accessible. We really just want to empower anybody to participate in this asset class with clarity and confidence. Want to remove the opacity and the friction of the old system. And so our vision is to build a world where everybody and anybody can build wealth through real estate with the ease and speed of a modern open market. Just like you could buy stock in seconds, you should be able to buy or sell exposure to New York or Austin or wherever seamlessly and instantly.
Awesome. And the best way people can do that is using Web3 tools and techniques through your platform.
That's our plan. We have not launched our mainnet yet. In fact, we're going to be launching season one of testnet in the coming days. So I would invite everybody to come take a look and see what we're building. You'll be able to touch it and experience it for yourself. And then really looking to solicit feedback from folks that have interest in the space, and as we prepare for our mainnet launch.
Awesome. Awesome. So you mentioned some cities, right? And you mentioned buying housing. Like, you know, I see a lot of things going on in the cities that kind of has me concerned about buying real estate there. I see some violence in like Chicago and in New York and LA and other areas. Um, should that be a legitimate concern for people investing, and or would they have opportunities to say they want to buy a piece of land in like South Dakota or something? How do you help people gauge their risk preference, and because that's something that's going to be like with the real estate and the economies and those cities, that's going to be like a major thing, right?
Yeah, I mean, for us, it's about empowering you to take action based on your perspective or your thesis. Uh, if you think that crime is continuing to be a problem and will only exacerbate housing prices, uh, with our product, you can take a short position on whatever neighborhoods or cities you think are being mismanaged or that have a bleak outlook. So you can make money in an area that is performing poorly by just, you know, picking the right side of that bet, I guess. Um, and so yeah, I mean, if you think that one area is going to appreciate better than any other area in the US, and you think one area is going to suffer and drop in value, you can you can basically put your money, align it with what your perspective and your thesis is, and see how it plans out, how it plays out.
You could do a long term short.
Well, I mean, yeah, I mean, effectively, if you can open up a short position, and typical to most short positions, you just have to maintain a collateral ratio. So if the market's moving against your short position, uh, you might take a bit of a haircut. You can always maintain the minimum collateral ratio to maintain that short position in the hopes that it works your way. But ideally, you take a short position, you're proven right, and you close out your position and pocket the difference.
There in 2008 and nine. There was a guy who did that against the whole entire U.S. housing market, made billions, right? So
Yeah, yeah. I mean, no, I mean, smart guy saw what was happening in the secondary markets, capital markets, seeing uh, not what I would consider to be the best level of diligence on on those financial products, and and he made a good bet. And yeah, I mean, similarly, I think all investing, it really boils down to: do you think it's going to go up? Do you think it's going to go down? And how do you take a position that's going to capitalize on where you think it's going to go? And
yeah,
and for us, it's we really just want to make it as simple as that. Do you think this market is going to go up? If so, then do this. If you think this market is going to go down, then do that. And if you're right, you will be rewarded. If you're wrong, unfortunately, you can lose some money. But that's the way investing works, right?
that's the way it works in crypto. So
I mean, show me any investing where, like, gosh, even my stock portfolio, there's some stinkers in there. I've, I've, I've had some bad days.
yeah, yeah, me too. So I see a lot of middle, like when I look at the real estate, like you have a better pulse on this than me. But when I see like real estate in suburbia America, I see BlackRock buying up entire neighborhoods, right? So, and that leads me to believe, question, what is the American dream used to be, house, picket fence, yard, couple kids, dog. It's not the American dream anymore for a lot of people. So what
Yeah.
is it? What is it? What is real estate's role in that dream, and how can the younger generations who no longer have that access to that dream, have a dream with real estate?
Yeah, yeah. Yeah, for me, I think the American dream represents a lot of different things. It's not, I wouldn't boil it down simply to, buying a house. I think a lot of it is about upward mobility and opportunity. The idea that America is a country where you can roll up your sleeves and you can work hard and be rewarded for it. Um, Part of that reward may have taken the form of having a house and the white picket fence and all this. I think that there's some people that's what they still want, and it's tough because mathematically this could be out of reach for many people. When you do have institutional players entering the housing market, that's just additional demand, and as we all know, what demand does to pricing, it can be a tough pill to swallow. That's for sure. So yes, it is lamentable that being able to own your primary residence is becoming less and less of a reality for everyday Americans. And that's partially why we are building Shareland. We want to empower people to build wealth in the housing market, um, even if they don't have access to the housing market. So being able to decouple that investment value from the physical asset itself, to at least retain the opportunity to speculate and grow money alongside that market, is one of the reasons why we built this product. But yeah, I think the desire to build wealth through real estate hasn't changed, and I think you know in today's day and age, the dream still retains the essence of mobility. Younger generations definitely want the upside of property appreciation, but some folks don't want to be tied to one location. And so you see this growing demographic of renters by choice, investors by design. And these are folks that we want to be able to empower. Um, they can build wealth in the housing market with the speed of a crypto native rather than the slowness of a bank.
Got it. So as far as macro trends in the residential real estate market, right? What are some of those trends today, and what do you see coming down the pike in the next year, half year, two
Oh
years?
man, uh, asking me for predictions, you're just going to get into trouble. But no, I like to speculate. I wouldn't be in the world I'm in if not for otherwise. Well, I don't know. I think interest rates are always kind of top of mind. Interest rates and prices always go hand in hand. Lower interest rates, the more uh, buying power that people have, drives prices up. One of the consequences of an elevated interest rate environment is this lock-in effect. I think we're facing a market where liquidity is dried up because homeowners are locked into low-rate mortgages. Um, the market is kind of stuck. I mean, if I want to move up in the housing ladder from the house I'm occupying, and maybe I have more kids and I want to get a better place, but like my the jump in my monthly overhead is going to just be a non-starter. Like I'd rather just stay in my smaller house with the lower monthly payment, with the lower rate, rather, I should say. And so, you know, I think over time, I'm not going to speculate on where rates are going, although I think inflation seems to be, in better control. I don't know. I think, but it would be easy to say that if rates come down, supply will reemerge, and that should free up some inventory for people. Although it kind of cuts both ways. Then there's more inventory, but then everybody has more buying power, and so sometimes I feel like it's an influence that's going to move prices down and an influence that's going to move prices up simultaneously, and so really tough to predict the long term result of that. Um, the other one is, I guess, they're calling it the silver tsunami. I mean, boomers owning nearly 42% of the housing wealth in this country. Historically, a lot of them would be downsizing by now, freeing up family homes. But again, there's just not a lot of them selling. And I don't blame people for not wanting to sell in the current environment. And so there's a lot of aging in place, and or they're just keeping the home as a rental cash cow. And so there's just this mismatch of inventory. We've got an entire generation holding on to the large houses where they raise their kids, while the next generation of parents don't have access to those family houses. And so I think that's one thing that could, if rates come down and we unlock a lot of that inventory, I think these are things that could help the average American out there and provide meaningful inventory to people. But yeah, until that inventory releases, I think price floors are gonna be pretty high.
Yeah, that makes sense. I've also noticed a liquidity lockup, not just in the crypto market, but equities, but everywhere really. And I'm wondering how we're going to get that liquidity unlocked. On a global sales, is a reduction of tariffs? Is it like something else? I know the government was shut down for 45 days, but like I didn't feel that at all. So I guess if you're traveling, you did. But how do you unlock the liquidity and get us to where we should be?
Oh man, that's $1 million question. Um, well, I guess there's a lot of uncertainty, and when there's uncertainty, people, I think liquidity comes off the table. Um, I think the most meaningful thing that could be done at a macro level, government level, policy level, would be things that would calm investors and create an environment where liquidity is a natural byproduct. I think, unfortunately, because of um, we had a pandemic, we've had some uncertain policies that are can be chaotic at times, and it creates an environment where liquidity flees. Um, and so I don't know. That's just kind of where my mind goes. I don't know if that's correct, but to me, I've always, I mean, you just see institutional capital moving from asset to asset based on a fear index. And I think if if we can drop the fear index and basically do things that make people have confidence, predictability, I think breeds confidence. Then that fear drops, liquidity comes back onto the table because people are going to fear missing out, all that FOMO. They're going to want to get in, and then I think that's where the progress happens.
Yeah, yeah. It didn't used to be where institutions would make fear-based decisions, but I'm seeing it more and more. You know,
Well, you've always seen money moving between long-term bonds and short-term bonds, and I've always felt that that was a good indicator of institutional sentiment. Um, are we going to get if we see the yield on long-term stuff starting to drop, people are that to me that implies that institutions are worried about what's coming, and because they're putting their money into into something safe, just to weather a storm, so to speak. So, but yeah, I don't know. Sometimes markets don't exactly behave logically. I think that is maybe what makes them exciting.
yeah, yeah. I live in Connecticut, right? And I know New York just elected um, a new mayor,
Sure.
and the mayor is Islamic mayor, and there's a lot of fear in the city that there's going to be more crime, that their value is going to decrease, and that they can flee to Connecticut, right? So I mean, that's good for me, but like my kids still got to go to school, and we're not moving out of my town, right? So
Mhm.
it's kind of like I can see the lockup. I can see a demand based on fear, you know,
Sure.
not based on opportunity, you know.
Yeah.
Eh,
Well, I've always thought intelligent investors are able to kind of separate the wheat from the chaff on that, right? I always like playing against the headlines. When everybody is running one direction because something just spooks them, I'm like, oh, great. This is a wonderful opportunity to get something on the cheap. Especially if you're not a short-term investor and you got the hands to hold it through the down period. I don't know. There was a guy. He's a travel. I think he has a travel blog, and one article he wrote that I really loved. He was like, anytime something devastating happens anywhere, he loves to go travel there. Like especially if it's something that scares people, like there was a bomb threat or anything like that. He's like, oh man, hotels are half off, flights are easy, no one's on your airplane because everybody's so afraid. And in reality, there's nothing to be afraid of. If you look at the fundamentals, um, it's still a great time. But everybody else is so worried about this perception. And so I think separating the perception from reality is key to keeping a level head. Whether it's crypto, equities, real estate, you name it. I think that that's universal.
yeah, I agree with you. Um, and there are different techniques and ways to do that. So we're not going to get into all that, right? Unless you have
Oh man. I mean, don't threaten me with a good time, but
unless you have some words of encouragement or wisdom when it comes to that.
oh man. Yeah, I think um, just gauging the emotion of any kind of news piece is a good start. Um, and is it speculative on what could happen versus what has happened? Um, and and yeah, I don't know. I think that media sentiment can carry things a little too far. Um, but at the end of the day, it's about keeping a level head and trying to understand like where's the value. And it works both ways. I mean, even in hot markets, like there's been so many times where you see some random altcoin or a meme coin run up, um, and I hesitate to get sucked into all that kind of stuff because as exciting and as shiny as it is, it's like uh, whatever the new speculation du jour is. When I was growing up, Beanie Babies were like this whole thing, right? And then now it's like, someone had this Beanie Baby collection that they would have killed somebody over, and now it's like worth nothing, right? And so I think that there is a very human element that we all are guilty of, and I think it's something that we just need to recognize in ourselves, recognize in others, recognize it, in the markets, and try not to get sucked into it. That's just kind of the rules that I try to live by. But sometimes if you see something and you're like, this makes sense, this adds value, this is going to help people perform a task that they need to perform, um, then I mean that's a good sign, and you should jump in and take advantage.
Yeah, I think I saw it on X today. In 2021, I started out podcasting, and I started out with like talking with all NFT creators. And at the time, there was like an NFT that was sold for
Yep,
$60 million, and it's worth $4,000 today. So
yep,
I think I'd
yeah,
rather bought a house. So
yeah. That's a great example. The NFT craze. Yeah, that one. I saw the writing on the wall on that one. You know, I luckily avoided too much there. I mean, but that's not to say that there aren't applications of that technology that don't make sense and add value. Like, um, you know, so I hate to throw the baby out with the bathwater, but yeah, when it's and also I just don't understand. I liken it to art collection, and that's a space that I just don't understand either. Some things I'm able to comprehend, and some things like other people talk, and I'm like, wow, like you really have insight into this that I don't think I would ever possess.
yeah,
But you know, and then hindsight is always it's always so easy to on Monday morning talk trash about the play the quarterback called. Like that's easy.
Yeah, it is. I'm an Eagles fan, so I saw us lose a 21.0 lead to Dallas, and I don't like so. But I'm not the quarterback, you know. But I do want to talk about that technological tool you said, and that technological tool you mentioned earlier was called the square foot token, right? So I want to
Yeah,
talk about that, the opportunities with that, how it's going to work, and how people can get it.
yeah, absolutely. So it all starts with our Oracle network, where we publish the average dollar per square foot of a given geography. So I am in Venice Beach, California, and let's just say the average house price in Venice, like if you wanted a 1,000 square foot house in Venice Beach, it would be 900 grand. I'm only using this just to use easy numbers. So it's $900 a square foot for houses in this neighborhood. Quite frankly, actually, I haven't looked lately, so I'm not totally sure. Um, and then we could say, Salt Lake City, Utah is, 550 a square foot or whatever it might be. We've created a what I liken to almost like a stable coin where it's pegged to that value. So it is a token where the intent is that it trades near or at that value. So you can buy and sell Venice token at $900 a token. Now, of course, folks that are familiar with the DeFi space that know synthetic tokens have seen these derivative products. They'll know this. This isn't I wouldn't say like wildly different than every other project out there. There's a few folks that have done this kind of a thing, and we've just chosen real estate because I think real estate as a inherently non-volatile asset class, this type of pegging mechanism um, is most applicable the less volatile the underlying asset is. So if it's a super volatile asset, the peg becomes meaningless. There's no way that an efficient market can react in time to maintain that peg. And so I wouldn't apply it to any other asset class that's volatile above a certain amount. Real estate is notoriously non-volatile. So I think it's a great application of the technology. So the idea is that um, you can mint a token, and the minting is always done as a ratio of that Oracle price. So let's just say there's a neighborhood that's $100 a square foot, um, and we require to 120% collateralization ratio to open up a short position by minting a token. So 120 bucks on the chain, locked up, out of touch for anybody, and then you get a token. You can then sell it to the automated market maker at whatever the prevailing market rate is. Let's just say we're perfectly pegged at 100 bucks. So you sell it for 100 bucks. Then your hope is that the value goes down. And then let's say it goes down to 95 bucks. You buy it back for 95. You then burn that token to get your collateral back, and you get to pocket that $5 difference. So that's the anatomy of a short sale, how you can speculate on the downside of a market and actually profit when housing markets go down. So if there's a neighborhood that you think is just like, oh my God, there's a new mayor, or there's a crime problem, or whatever is going on, and you have reason to believe that the housing prices are going to drop, and you want to bet on that, well, that's how you would do it. On the flip side, going long is way easier. You're basically just walk up to the AMM, whatever the prevailing price is, you snag a token. It's a USDC to square foot token swap. And then to be clear, each neighborhood is its own AMM with its own square foot token. And so that's basically how it works. And there's a bunch of different mechanisms that maintain that peg. I liken it to like a rubber band. Like if I held a rubber band between these two fingers, like I could move this hand down pretty easy, but eventually it starts to get really tight, and there's a lot of force pulling my finger back towards the oracle value. And on the flip side, it goes up here, it pulls down. So there's a number of what I would call self-correcting systems in the way that the math is done in these types of DeFi exchanges, of which we're if you've heard this before, then we're not going to surprise you too greatly here. But one example I'll give is the fact that minting is pegged to the actual real world price means that a token is never going to trade for more than the minting price. Because why would I buy a token for more than I can mint one for? And so that creates a natural arbitrage pressure, a downward price pressure that will prevent a token from exceeding the value of the real world by a certain degree. Um, and before it even hits that mint price, like going short, let's just say that I was thinking about going short, but like, I don't know, like risking $20 to hope it goes short, that's one thing. But if it's trading at a big premium, everybody's going long, everybody's buying tokens, and so the token price starts to creep up. Well, my cost to go short evaporates. Effectively, the longs are daring me to take the short side of the equation. And so then, if that red carpet's rolled out for me, and I want to take the short side, well, I will. And simultaneously, I will restabilize the peg by doing so. So this is just another example of like how, because functionally it's basically there's longs and there's shorts. Depending on how things go, one of them is going to pay the other. And then there's kind of the market price of the token, which can be either a premium or a discount to the real world price. And that's going to basically be a measurement of market sentiment. So if everybody thinks it's going to go up, it's likely going to be trading at a premium, which means that the shorts are, going to get incentivized to join the equation. And so it's like over under in sports betting. Like if you've got two sports teams and one's the number one and the other one's dead last, no one is going to bet on the dead last guy. But if we give them a 50-point spread, then all of a sudden that's looking like a good bet, right? And so similar mechanic where to that where the token will trade at a premium or a discount to the real world asset price, and that is going to balance the equation to make it so that the longs and the shorts both have a chance of potentially winning in this game. And then we see how the reality pans out. And so, similar to prediction market methodologies, it's that's what we built.
It sounds really good. I have a couple concerns. One is,
Sure.
I'm not sure how the Genius Act plays into focus here. Like with the stable coins, I thought everything had to be pegged to the dollar. And what I hear you saying that I don't understand is
I use that
you
as a metaphor, by the way. It's not a
okay,
stable coin. It's not, we're not holding, there's no, we're not holding US dollars in Treasury Reserve or anything like that. So we're not intending this to be a stable coin. It's maybe not a great metaphor to use
okay,
because, the history of like, yeah, it's just not a stable coin. I guess
okay.
I just use it as shorthand.
Great. And the industry got in trouble because of the algorithmic unpegged, coins, to Terra Luna. So I'm like, how is this going to differ from Terra Luna?
Yeah. Oh, well, Terra Luna, their critical error was allowing swaps between their stablecoin and free floating token. Basically just saying like, hey, you can always trade this token for this stablecoin, and then the second there's a run on the bank, it goes into a tailspin. We actually, uh, when we were, thinking about all the different ways that we could build a product that allowed people to have kind of this tangible square foot. Like I've got 100 square feet of LA. Have got 100 square feet of Miami. I've got this growing portfolio of square feet around the globe. Um, we considered, the idea like, well, what if we had a platform token and, that had some kind of mechanism that allowed people to arbitrage to as a way to strengthen the peg. But after what happened to Terra Luna, I was like, absolutely not. You cannot have a peg mechanism that involves another token that isn't pegged to anything because I mean, we all know what happened. So uh yeah, that's it. The other thing is when I said volatile assets being bad for this, equally bad are assets where like like what I'm describing is a soft peg mechanic, right? Like it doesn't need to be a hard peg. I like the Venice Beach square foot token. If it doesn't trade at 900 square foot, it doesn't end the world. Like nobody's clearing this as if it was as good as fiat currency. In fact, by design, we want it to shift a little bit because if it was always at 900, shorts would be like, well, take a hike. I'm not taking that bet. And so those weaknesses in Terra Luna and algorithmic stablecoins, those are only weaknesses when you're trying to peg to a fiat currency. And it's exacerbated when you have your own kind of ecosystem token as this like arbitrage bridge to as an attempt to stabilize the peg. Yeah, that was fraught from the beginning. But you know what? Just because a hammer sucks at banging screws into drywall doesn't mean it doesn't drive a nail. You know what I mean? And so I still think that this is great technology that if it's applied to the right asset class in the right way, it can do some really cool and interesting things.
Yeah. I think so too. The other thing I thought of when you were explaining that you have a different square foot token for every city,
Yeah.
I immediately thought of CryptoKitties, and that being an extension or a better use of the technology for CryptoKitties.
Oh man. But that was more like NFTs, right? And you'll have to forgive me. I'm not like CryptoKitties expert. So ours are not NFTs. It's ERC20 token. You know, I would say if you took a look at Synthetics IO, like they they were trying to do like a platform where it's for make your own synthetic, peg to whatever you want, in kind of a DIY kind of way. For us, we're basically taking um, that same mindset, but really making it super easy. I think one of the problems with the Web3 space is that like it's a community building for itself, almost to the exclusion of the average person out there. Like, I want to make something a little bit more inclusive that anybody can use. Like, I love a lot of the technologies that are being built in the space that kind of can create a Web 2 like experience. For example, we use Privy. I love these guys. Like allow your users to sign in with Google, generate a wallet on the back end, and then if you've got a fiat on ramp or off ramp, now all of a sudden people can transact with credit cards. Now it's all crypto rails on the background, so it has that transparency and all the things that we love about Web3 and what really empowers some really cool things to happen. And so one of my goals is to kind of blend both worlds. I want to have my cake and eat it too. I always give this example about my dad. Like my dad, he lives down in San Diego. The majority of his net worth is tied up into his house. I would love to be able to empower him to hedge against that. I mean, his whole like his lifestyle now that he's retired is like tied to this one asset. It can be severely dangerous. Um, but if I was going to ask him to install a MetaMask wallet, authenticate with a DeFi platform, acquire some stable coin and gas from a centralized exchange, transfer that over to his hot wallet and conduct on it, like he would have already told me like no. You know what I mean? He'd be like, what are you talking about? Instead, I want to say, hey, look, you sign in with Google like you do with anything else. You pop in your credit card number and you can take a short position on San Diego. And if anything ever happened, you'd have a little bit of an insurance policy, so to speak, against your nest egg. And so yeah, I want to keep it simple. I want to have it be easy to understand, but it's a challenge. It's Web3. Sometimes it's just not easy to explain. It's you know we're having this conversation, and your audience is a lot of Web3 folks that know the space, and I bet this is even kind of like even if we have a hard time narrowing down exactly the specifics of the mechanics of how this works and conveying it easy to understand to other people. But at the end of the day, I hope that it's tangible. Go to the testnet, check it out. We slap 100,000 USDC test USDC into your account. You can buy and sell some tokens, see what it does. You can see the Oracle price history. You can compare that to the market price of the token. You can see that it's like they'll have the same shape, but one will either it'll be the market price will either be like superimposed up or superimposed down relative to market sentiment, which is actually kind of cool. One of the things I'm really excited about is that you'll be able to use platforms like this, like prediction markets, whether it's Polymarket, Kalshi, um, uh, us for real estate. And I think that we're going to see that when people have to put their money where their mouth is on these prediction markets, it's going to be invaluable predictive data. Um, you know, like that's one of the cool things that I'm excited about in just the prediction market space as a whole. Um, just to see how that will give us all more insight into what's to come.
Awesome. Sounds exciting to me. And I want to thank you very much for your time today. It's been an enjoyable conversation. Um,
Oh, my pleasure.
and one last question for you. It's probably the easiest
Sure.
one. It's how can people find out more information about you, about Shareland? How can they start to bet on the real estate market in the U.S. or own real estate how can they do that?
Yeah, yeah. Well, first of all, my email address is justin@share.land. I try to make myself available and accessible. I'm not hiding anywhere. I like to talk to people. You can also find us on X. It's actually share.land. That was the handle because I guess share was taken when we started. And then yeah, come to www.share.land, testnet.share.land. But yeah, we're not hard to find. Hit me up anywhere. And I would love to get feedback from folks on what we're doing. And yeah, so that's it.
Awesome. Thank you very much for your time today.
Yeah, thank you. Bye.